$25 billion. That's what someone told me Ethereum's entire network was worth when they called last Tuesday. Same fellow wanted to know if he should sell his rental properties to buy more of it. Said Ethereum was going to flip Bitcoin, whatever that means. Told me about smart contracts and decentralized finance and how this was going to replace every bank on earth. And he kept using words like revolutionary and game-changing and the future of money. I asked him one simple question. If you couldn't sell your Ethereum for 10 years, would you still buy it today? He went quiet. Then he said, well, I'd probably want to take profits before then. That's when I knew he didn't understand the difference between investing and gambling. And that's exactly the problem with Ethereum and every other cryptocurrency that's followed in Bitcoin's wake. People think I'm just an old man stuck in the past when I say these things. They say I don't understand technology. They say I missed the internet revolution, which isn't true, by the way. We own significant stakes in Apple and Amazon. They say I'm too conservative, too risk-averse, too traditional in my thinking. But in 75 years of investing, I've learned something that never changes, no matter how much technology advances. An asset has to produce something of value. It has to generate cash flow. It has to create wealth rather than just transfer it from one person's pocket to another's. Ethereum produces nothing. And that's why I believe it's heading to zero, just like every other speculative bubble throughout history. Now, before you stop listening because you think I'm just another Bitcoin skeptic applying the same logic to Ethereum, let me explain something. Ethereum is actually different from Bitcoin in important ways. And those differences make it even more concerning, not less. The Ethereum believers have constructed an even more elaborate story than the Bitcoin folks. They've built an entire ecosystem of applications and tokens and protocols on top of it. They've convinced some very smart people that this is the foundation of a new financial system. And that's precisely why more people are going to lose more money when this house of cards comes tumbling down. Let me start by explaining what Ethereum actually is, because I've noticed most people who own it can't really tell you. Bitcoin's pitch is relatively simple. It's digital gold, a store of value, a hedge against inflation. You can explain it in a sentence or two. Ethereum's pitch is far more complex, and complexity is often where the danger hides. Ethereum calls itself a world computer. It's a blockchain platform where developers can build what they call decentralized applications. These applications run on thousands of computers around the world rather than on centralized servers owned by companies. The idea sounds revolutionary at first. Instead of Facebook controlling your social media data, you'd control it yourself through a decentralized application. Instead of banks controlling your money, you'd interact directly with smart contracts that execute automatically based on code. Smart contracts are really the core innovation Ethereum claims to offer. These are self-executing contracts where the terms are written directly into code. For example, instead of using a lawyer and escrow service to buy a house, you'd theoretically have a smart contract that automatically transfers ownership when payment is received. No middleman, no delays, no fees to third parties. It happens automatically based on the code. On top of this platform, developers have built thousands of applications. There are decentralized exchanges where you can trade cryptocurrencies without a centralized company like Coinbase. There are lending platforms where you can borrow and lend cryptocurrency without a bank. There are insurance protocols, prediction markets, digital art platforms called NFTs, and virtual worlds where people buy digital real estate. The Ethereum enthusiasts call this decentralized finance, or DeFi for short. They say it's going to replace traditional finance entirely. Vitalik Buterin, the young fellow who created Ethereum, built it back in 2013 when he was just 19 years old. Now, it has a market cap that's fluctuated between $200 billion and $500 billion, depending on market sentiment. That's a valuation higher than JP Morgan Chase or Bank of America. Think about that for a moment. A piece of software created by a teenager is supposedly worth more than banks that have been around for over a century, employing hundreds of thousands of people, holding trillions in assets, and generating tens of billions in annual profits. The believers point to Ethereum's ecosystem as proof of its value. Unlike Bitcoin, which they admit is mostly just a speculative asset, Ethereum actually has applications being built on top of it. There are real developers writing real code. Real users are interacting with these applications. Real money is flowing through these DeFi protocols. At its peak, DeFi protocols on Ethereum had over $200 billion locked in them. They compare Ethereum to the early internet infrastructure. They say Ethereum's like the HTTP protocol or TCP/IP. It's the foundational layer that everything else gets built on top of. And just like Microsoft and Amazon built massive businesses on top of internet protocols, thousands of businesses will be built on top of Ethereum. Those who own Ether, the native cryptocurrency of Ethereum, are essentially owning a piece of this new financial infrastructure. Here's where the pitch gets really sophisticated. Unlike Bitcoin, which just sits there doing nothing, Ether actually has utility within the Ethereum ecosystem. You need to pay Ether to execute transactions on the network. You need Ether to deploy smart contracts. You need Ether to interact with all these decentralized applications. So there's actual demand for Ether beyond pure speculation, or at least that's what they claim. Furthermore, Ethereum recently went through something called the merge, where they changed how the network operates. Now, if you own enough Ether and stake it in the network, you can earn a yield somewhere between 4% and 7% annually. The Ethereum bulls say this makes Ether similar to a bond that pays interest, except the supply is also limited, making it deflationary under certain conditions. They call it ultrasound money because it's supposedly better than Bitcoin. Institutional investors are taking notice too. Just like with Bitcoin, we're seeing major financial institutions offer Ethereum ETFs. Grayscale has an Ethereum trust. Fidelity offers Ethereum exposure. Major corporations have invested in Ethereum-based projects. JP Morgan has experimented with Ethereum for interbank transfers. Microsoft partnered with Ethereum for some cloud services. Even Mark Cuban has said he thinks Ethereum has more utility than Bitcoin. The developers point to real technological problems that Ethereum could theoretically solve. Cross-border payments currently take days and cost significant fees. Ethereum transfers happen in minutes for dollars in fees. Getting a loan from a traditional bank requires credit checks, paperwork, and waiting periods. On Ethereum's DeFi platforms, you can get a loan in seconds by putting up collateral. Buying stocks requires brokers, clearinghouses, and settlement periods. On Ethereum's decentralized exchanges, trades are peer-to-peer and settle immediately. They'll tell you about NFTs, those digital art pieces that sold for millions of dollars. Yes, I know most of that market has crashed, but they say it proved the concept of digital ownership and property rights. They'll tell you about DAOs, decentralized autonomous organizations where communities can pool money and vote on how to use it without traditional corporate structures. They'll tell you about the metaverse, where people will own digital land and digital goods, all tracked on Ethereum's blockchain. The most sophisticated Ethereum bulls make an interesting argument about network effects. They say Ethereum has already won the smart contract platform race. Yes, there are competitors like Solana, Cardano, and others, but Ethereum has the most developers, the most applications, the most liquidity, and the strongest community. In technology, they argue the winner takes most of the market. Look at how Facebook beat MySpace, how Google beat Yahoo, how iPhone beat BlackBerry. Ethereum, they say, is that dominant winner in the blockchain space. And here's their kicker. They admit Bitcoin is probably just digital gold that doesn't do anything. But Ethereum is programmable money. It's a platform for financial innovation. Every new application built on Ethereum increases the value of the network. Every transaction generates fees that go to Ether holders who stake their coins. It's productive, it generates yield, it has utility. This isn't speculation, they insist. This is investing in the infrastructure of the future financial system. I can see why people find this compelling. The pitch is far more sophisticated than Bitcoin's number go up narrative. There's real technology here, real innovation, real problems being addressed, real smart people working on this. So when I say Ethereum's going to zero, people think I'm just dismissing something I don't understand. But here's what I do understand. After 75 years of investing, and this is critical, just because something is technologically innovative doesn't mean it's a good investment. Just because something solves a problem doesn't mean it will generate lasting value for investors. Just because smart people are working on something doesn't mean it will succeed. And just because something could theoretically be worth a lot doesn't mean it actually is worth anything today. The fundamental question I always ask about any investment is simple. What am I actually buying? Not what do I hope it becomes, not what the story says it could be worth, but what am I actually buying right now for my money? When I buy Coca-Cola stock, I'm buying a piece of a company that sells beverages people want to drink. The company owns bottling plants, distribution networks, one of the most recognized brands on earth, and relationships with retailers worldwide. Every day, people buy Coca-Cola products. The company collects revenue. After paying expenses, there's profit. Some of that profit gets reinvested to grow the business. Some gets returned to shareholders as dividends. I'm buying a stream of future cash flows from productive enterprise. When someone buys Ethereum, what are they actually buying? They're buying a cryptocurrency token that gives them the right to pay transaction fees on a network. Now, the Ethereum bulls will say, no, you're buying part of the infrastructure of the future financial system, but infrastructure doesn't become valuable because it exists. Infrastructure becomes valuable when it generates cash flow for its owners. Let me give you an example. Railroad infrastructure was genuinely revolutionary. It transformed America. It was absolutely crucial to economic development. Railroad companies employed hundreds of thousands of people, moved millions of tons of goods, and were essential to commerce. But you know what? Most railroad investors lost their shirts. The vast majority of railroad companies went bankrupt. The infrastructure was valuable to society, but it wasn't valuable to investors because there were too many railroads, too much competition, too much capital required, and not enough profits to go around. The same was true of the automobile industry. Cars changed the world, but there were over 2,000 automobile manufacturers in the early 1900s. How many survived? A handful. The rest disappeared, taking their investors' money with them. The technology was revolutionary. Society benefited enormously, but most investors lost everything. Or take the internet, since Ethereum bulls love that comparison. Yes, the internet changed everything, but do you remember the dot-com bubble? Companies with no revenue and no path to profitability were valued at billions of dollars because they had .com in their name. Pets.com, Webvan, eToys, hundreds of others. They all went to zero. The infrastructure was valuable. The technology was revolutionary, but that didn't save investors who paid ridiculous prices for companies that produced nothing. Even among the survivors, most investors still lost money. Amazon dropped 95% from its peak during the dot-com crash. If you bought near the top in 1999, it took you 9 years just to break even. And Amazon was one of the best companies with real revenue and real products and real customers. Most companies never recovered at all. So when Ethereum enthusiasts tell me blockchain is like the early internet, they're making my point for me. The internet was revolutionary, and it still destroyed the wealth of investors who bought the hype rather than analyzing the fundamentals. Now let's talk about what Ethereum actually produces. And I mean actually produces, not theoretically could produce or might produce someday. What cash flow does Ethereum generate for token holders? The answer is essentially nothing. Yes, if you stake your Ether, you can earn a yield of around 4 to 7%. But where does that yield come from? It comes from inflation of the money supply and from transaction fees. You're not being paid from profits generated by productive economic activity. You're being paid in more Ethereum tokens or from fees that other users pay to use the network. This is not the same as a dividend from Coca-Cola or Apple. Those companies generate profits from selling products that customers want to buy. The profits come from economic value creation. Ethereum's yield comes from other people using the network or from diluting the money supply. That's not value creation, that's just wealth transfer. Let's examine the transaction fee argument more closely. Yes, Ethereum generates billions of dollars in transaction fees annually. At its peak, The network was generating over $10 million per day in fees. The Ethereum bulls say, see, the network is generating revenue. It's like owning a toll road. But here's the problem. High transaction fees aren't a sign of success. They're a sign of failure. The entire point of blockchain technology was supposed to be fast, cheap, borderless transactions. Instead, at times, during the DeFi boom, it cost over $100 just to execute a simple transaction on Ethereum. That's not disrupting traditional finance. That's worse than traditional finance. The Ethereum developers recognize this problem, which is why they've spent years working on solutions to make the network faster and cheaper. But think about what that means. If they succeed in making transactions much cheaper, the fee revenue collapses. If they fail to make transactions cheaper, nobody will use the network because it's too expensive. Either way, the investment thesis falls apart. Compare this to a real business. If Coca-Cola improves efficiency and reduces costs, the company makes more profit. That's good for shareholders. If Coca-Cola maintains quality while charging premium prices, they make more profit. Also good for shareholders. The business model works in both directions. With Ethereum, there's a fundamental tension. Make it cheap and useful, but then there's no fee revenue. Keep fees high, but then it's not useful. This is not a sustainable business model. The DeFi ecosystem built on top of Ethereum has the same problem. Yes, there are lending platforms and decentralized exchanges built on Ethereum. And yes, they process billions of dollars in transactions. But what are they actually doing? They're allowing people to speculate on cryptocurrencies and trade one cryptocurrency for another. That's not creating economic value. That's just gambling with extra steps. The DeFi lending platforms don't lend money to businesses to expand operations or families to buy homes. They lend cryptocurrency to speculators who want more leverage to make bigger bets on cryptocurrency prices. When cryptocurrency prices go up, everyone thinks they're a genius. When prices crash, the whole thing unravels in a cascade of liquidations and losses. We saw this exact pattern in 2022. The DeFi ecosystem looked unstoppable. Luna and Terra, which were built on similar smart contract principles as Ethereum, were worth tens of billions of dollars. Then the whole thing collapsed in a matter of days. Billions of dollars of supposed value vanished. Companies like Celsius and BlockFi that were built on these principles went bankrupt. Three Arrows Capital, a major cryptocurrency hedge fund, completely imploded. FTX, which was one of the largest cryptocurrency exchanges, has turned out to be a fraud and collapsed, taking billions of customer money with it. The Ethereum bulls will say, but Ethereum itself survived. The protocol kept running. That proves its resilience. Sure, the protocol survived. Tulips also survived, the tulip mania. You can still buy tulips today. The question isn't whether Ethereum continues to exist. The question is whether it's worth current prices. Let me address the smart contract argument directly because this is central to Ethereum's value proposition. Smart contracts are supposed to replace lawyers, banks, and middlemen by automating agreements through code, but there are fundamental problems with this idea that Ethereum enthusiasts don't want to acknowledge. First, code is written by humans, and humans make mistakes. We've seen countless examples of smart contracts with bugs that got exploited, resulting in hundreds of millions of dollars being stolen. The DAO hack in 2016, the Parity wallet freeze, countless DeFi protocol hacks. When a traditional contract has a dispute, you go to court. When a smart contract has a bug, your money is just gone. There's no recourse, no insurance, no protection. Second, smart contracts can't exist in isolation from the real world. If you're using a smart contract to buy a house, someone still has to verify that the house actually exists, that the seller actually owns it, that there are no liens against it, and that the property transfer is legally valid. You still need title companies, inspectors, and lawyers. The smart contract doesn't eliminate the middlemen. It just adds an additional layer of complexity. Third, who do you trust to write these smart contracts? If I'm going to put my life savings into a smart contract, I need to verify that the code does what it's supposed to do. But I'm not a programmer. Most people aren't. So I need to hire someone to audit the code. Congratulations, I've just reinvented the lawyer, except now I'm paying both a lawyer and a programmer. The truth is, middlemen exist for a reason. They provide trust, verification, dispute resolution, and accountability. Smart contracts don't eliminate the need for trust. They just shift it to trusting that the code is correct, which most people have no ability to verify. Let's talk about the environmental and technical issues that Ethereum supporters conveniently gloss over. Yes, Ethereum moved to proof of stake, which uses less energy than Bitcoin's proof of work. That's good. But the network still has serious scalability problems. Ethereum can process about 15 to 30 transactions per second. Visa processes 65,000 transactions per second. If Ethereum is supposed to be the foundation of a new financial system, it needs to handle at least as many transactions as the current system. Various layer 2 solutions are being developed to increase capacity, but this adds complexity, additional costs, and additional trust assumptions. The more complex a system becomes, the more points of failure it has. Furthermore, the Ethereum protocol is constantly changing. There have been numerous hard forks and upgrades. The move to proof of stake was years behind schedule. Future upgrades are planned that will fundamentally change how the network operates. This isn't a stable, mature technology. It's an ongoing experiment. When you buy Ether, you're not just betting that the current protocol has value. You're betting that future upgrades will work as planned, won't introduce new vulnerabilities, and will maintain backward compatibility. That's a lot of execution risk. Compare this to owning shares in a stable business. Coca-Cola's formula hasn't fundamentally changed in over a century. The business model is proven and consistent. With Ethereum, the protocol itself is under constant revision. What you're buying today might work completely differently in 5 years. That's not an investment. That's speculating on the execution ability of developers. Here's something else that troubles me deeply. The Ethereum ecosystem is rife with fraud, scams, and manipulation. I'm not saying Ethereum itself is a scam. I'm saying it has become a platform for scams. The ICO craze of 2017 and 2018 saw thousands of projects raise billions of dollars by creating tokens on Ethereum, promising revolutionary technologies, and then delivering nothing. The vast majority of those projects are now dead, and the money is gone. The NFT boom of 2021 was similarly absurd. Digital images selling for millions of dollars based purely on speculation and hype. Art is supposed to derive value from its aesthetic appeal, its cultural significance, or its scarcity. A digital file that can be infinitely copied has none of these properties. The fact that a blockchain says you own the original doesn't change the fundamental reality that anyone can view, save, and use the image. The NFT market has since collapsed by over 90%. Where did that value go? It never existed in the first place. DeFi protocols have been repeatedly exploited by hackers who find vulnerabilities in smart contracts and drain funds. In 2021 and 2022 alone, over $3 billion was stolen from DeFi protocols. $3 billion. That's not a few isolated incidents. That's a systemic failure of security. Traditional banks get robbed too, but when they do, the money's insured. When a DeFi protocol gets hacked, your money's just gone. The regulatory risk is enormous and growing. Governments around the world are waking up to cryptocurrency, and most of them don't like what they see. It's being used for money laundering, tax evasion, ransomware payments, and sanctions evasion. The SEC has indicated that many tokens, possibly including Ether itself, might be unregistered securities. If Ethereum is classified as a security, the regulatory requirements would fundamentally change how it operates and who can legally use it. China has banned cryptocurrency trading entirely.
Other countries are considering similar moves. Even if Ethereum isn't banned outright, increased regulation will likely eliminate many of the supposed advantages of decentralized finance.
If you have to do KYC verification, report your transactions to the IRS, and comply with securities laws, you might as well use traditional finance, which is faster, cheaper, and more user-friendly. The Ethereum enthusiasts talk about censorship resistance and permissionless access as key features, but most people don't need censorship resistance. Most people live in countries with functioning legal systems. where their money is safe in regulated banks. The people who really need censorship resistance are criminals, sanctioned entities, and residents of authoritarian regimes. That's a pretty limited market, and it's a market that governments are highly motivated to shut down. Let me be very clear about something. I'm not saying blockchain technology is useless. There might be legitimate applications for blockchain in supply chain management, medical records, property titles, or other areas. But here's the key distinction. You don't need to own Ether to benefit from blockchain technology being useful, just like you didn't need to own Bitcoin to benefit from the internet being revolutionary. If blockchain technology becomes widely adopted, the beneficiaries will be companies that integrate it into their business models to deliver better products and services at lower costs. Maybe that's Amazon using blockchain for supply chain transparency. Maybe that's hospitals using blockchain for medical records. Maybe that's governments using blockchain for property registries. But those use cases don't require Ethereum specifically, and they certainly don't require Ether to be worth hundreds of billions of dollars. In fact, the most likely scenario is that if blockchain technology proves genuinely useful, large corporations and governments will create their own private blockchains that they control. They won't build on Ethereum where they have to pay fees, follow protocol rules set by anonymous developers, and expose themselves to the volatility and regulatory uncertainty of cryptocurrency markets. JP Morgan created JPM coin for interbank transfers. It's blockchain-based, but it's not built on Ethereum, and it doesn't use a volatile cryptocurrency. It's just blockchain technology uses a database. That might actually be useful, but it doesn't create investment value for Ethereum holders. Here's the pattern I've seen over and over again in my career. Technological innovation is real. Societal benefits from that innovation are real, but investment returns don't automatically follow from innovation. Most of the value from innovation goes to consumers in the form of better products and lower prices, not to investors. The internet made everyone's lives better, but it destroyed the business models of newspapers, bookstores, travel agents, music stores, and countless other industries. Investors in those industries lost fortunes. The internet created enormous consumer surplus, but capturing that surplus as an investor required being in the right companies at the right prices, which very few people managed to do. I suspect blockchain will follow a similar pattern. If it's truly useful, it will be adopted in ways that benefit consumers and businesses. But that doesn't mean cryptocurrency holders will capture that value. More likely, they'll be left holding worthless tokens while the real value accrues to companies that use the technology effectively. Now, let's talk about what happens when Ethereum goes to zero, because I believe it will. Not tomorrow, maybe not next year, but eventually. Here's how I see it playing out. First, there will be a trigger. Maybe it's a major hack that exposes fundamental flaws in the protocol. Maybe it's definitive regulatory action that classifies Ether as a security and makes it illegal to trade without proper licensing. Maybe it's a competing platform that's genuinely better, faster, and cheaper. Maybe it's just that people slowly realize there's no there, no fundamental value being created. When that trigger happens, prices will start to fall. At first, the believers will say it's just a temporary dip, a buying opportunity. They'll talk about diamond hands and holding through the dip, but as prices continue to fall, reality sets in. The people who were staking Ether to earn yield will unstake and try to sell. This will create a cascade of selling pressure. The DeFi protocols built on Ethereum will start to unravel. Loans will get liquidated. Collateral will be sold into a falling market. The feedback loops that push prices up on the way up will work in reverse on the way down. Protocols that seem stable at high prices will reveal themselves to be Ponzi schemes when prices fall. Developers will stop working on Ethereum projects and move to the next hot thing. Users will leave for platforms that are cheaper and faster. Liquidity will dry up, making it harder and harder to sell at any price. Eventually, Ethereum will join the graveyard of failed cryptocurrencies. It might technically still exist with a few diehard believers keeping nodes running, but it will be effectively worthless. The true believers will say, I'm wrong. They'll say, I'm too old to understand new technology. They'll say, I missed the boat on the greatest investment opportunity of a generation. They said the same thing to me in 1999 about dot-com stocks. They said the same thing in 2006 about real estate. They said the same thing about gold in 2011 and Bitcoin in 2021. Here's what I've learned. When everyone thinks you're foolish for not joining them, that's usually the exact moment you should be most cautious. When speculation becomes indistinguishable from investment in people's minds, fortunes are about to be lost. When complex narratives replace simple fundamentals, bad things are coming. I sleep well at night because my wealth is built on businesses that produce things people need, that generate cash flow, that return capital to shareholders, businesses that will still be here in 10 years, 20 years, 50 years, doing the same essential things they do today, making beverages, selling insurance, transporting goods, generating power. The fellow who called me about selling his rental properties to buy Ethereum, I told him the same thing I'd tell anyone reading this. Your rental properties might not be exciting. They might not make you feel like you're part of a technological revolution, but they house families who need a place to live. They generate rental income every month. They've been generating rental income for your family for years and will continue to do so. Ethereum generates nothing except the hope that someone else will pay more for it tomorrow than you paid today. That hope works for a while. It can work for years. But hope is not an investment strategy. Hope is gambling. And in gambling, the house always wins eventually. I've said this about Bitcoin, and I'll say it about Ethereum. If you offered me all the Ethereum in the world for $25, I wouldn't take it. What would I do with it? I'd have to sell it back to you because it doesn't do anything. It doesn't produce anything. It doesn't generate cash flow. It just sits there waiting for the next person to come along. That's not investing. That's speculation. And speculation works until it doesn't. When it stops working, the losses are catastrophic and permanent. I've seen this story play out dozens of times over my career. The technology changes, the narrative changes, the asset class changes, but the fundamental pattern is always the same. Prices rise beyond any rational valuation. Smart people convince themselves this time is different. Everyone who questions it is dismissed as not understanding the new paradigm. And then reality reasserts itself, usually quite suddenly and painfully. Ethereum might go higher before it goes to zero. I freely admit that. Bubbles can inflate for longer than rational people expect. But the higher it goes, the harder it will eventually fall. The more people who get sucked in, the more catastrophic the eventual collapse will be. You have a choice to make. You can chase the excitement and the hope of getting rich quick, or you can build wealth slowly and steadily by owning productive assets that compound over time. One approach feels boring but works. The other feels exciting but destroys wealth. 75 years of investing has taught me that boring wins every single time, without exception. I'll take boring over exciting every day of the week and twice on Sunday, because boring lets me sleep at night knowing my wealth is built on solid ground rather than hope and speculation. Ethereum is going to zero, not because I want it to, not because I'm rooting against technology or innovation, but because that's where all speculation eventually ends up. The only question is whether you'll still be holding it when it gets there.